Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, January 13th, 2022, and I'm pre-recording this Trading Places Live for just a bit later this morning. We've had a lot of movement to the upside recently in the market, and this morning we're seeing slight gains in the futures. We've got the Dow Jones futures up 47 points, S&P 500 futures up about 4 points, NASDAQ futures up about 15. Crude oil taking just a little bit of a breather. It's been on a tear to the upside, down about 0.5% so far today. And we are seeing a little bit of a rise again in the 10-year Treasury yield, up 2 basis points this morning to about 1.74%. Let's go through today's agenda. We will start off, of course, with the daily market recap. I'll take a look at that Wednesday action for you. Then jump into talking technically. Momentum sleepers. I haven't done that segment in a while, so I thought we'd see what's been kind of lying to the side, not really doing a whole lot. We've seen so much rotation in the market. I think it would be a good time to see what's been sleeping. Then we'll get into the earnings spotlight and wrap it up with the three you must see. These are 3 Dow stocks that I'm going to look at today. All right, before we get into any of that, let's take you over to earningsbeats.com. If you go over to earningsbeats.com, if you're new to us, always like to point out at the beginning of the show, the Earnings Beats Digest newsletter. This is a newsletter that's published 3 times a week. Very quick read, usually just a couple paragraphs and a chart talking about things like earnings, gaps, relative strength, things that really matter to us at Earnings Beats. We try to make it very educational, but clearly, our subscribers are free to trade it as they desire, or trade those potential candidates as they desire. All it takes is a name, email address, hit that subscribe button, and you'll be good to go. There's no credit card required, and you can unsubscribe at any time. We'd love to have you. One other thing to mention too is once you're part of our community, that free newsletter community, any of our free events, we'll make sure we get room instructions out to everybody on that list. And we do a lot of free webinars throughout the year. So that's another key reason why you would want to subscribe. All right, let's take a look at the daily market recap. What happened on Wednesday? Well, it was mostly a flat day, especially when you compare it to what we've been seeing with the craziness. First, the big drop at the beginning of January, and then the big rally earlier this week. Yesterday was a little quieter, which was probably a good thing for many. Dow Jones up 38, S&P up 13, NASDAQ up 35. So on a percentage basis, we had a little bit of leadership from the S&P 500, rising almost 0.3%. Mid caps and small caps, however, did take it on the chin. Again, that's been a theme throughout much of 2021 and into 2022. Underperformance in the mid caps and small caps. Mid caps were down 0.3%. Small caps down almost 0.5%. As far as sectors go, materials were the leader on Wednesday, gaining just over 1%. Consumer discretionary, we haven't talked about discretionary leading very much of late. Well, they were in the second spot, gaining about 0.2% on Wednesday. Technology also up almost 0.5%. Utilities gaining roughly about 1/3. And even though they're not showing on here, industrials also gained about 1/3%. The loser yesterday was healthcare. So healthcare stocks got back up, tried to get through their 20-day moving average and failed. We also saw technology testing their 20-day moving average and closing beneath it. And the XLY also went up, challenging that 20-day EMA before falling back below. The reason I bring this up is that most of these areas, especially you can see discretionary, kind of sideways consolidating. Well, sometimes when a downtrend is first beginning, one of your early clues is that a rally fails at the 20-day. It's not a guarantee, but I look at it because if we get back through the 20-day, I'm still thinking consolidation. If we fail at the 20-day and start to roll back over, that's when I start thinking about a possible downtrend. Now, if there's a positive on this chart, is that even though we've been going sideways here for the last couple of months, the AD line is actually broken out to the upside on discretionary. So that's painting a little bit more of a bullish sign. It doesn't mean we're going to go up right now, but it does mean that as we've been going sideways, it appears as though Wall Street has been accumulating. Same goes for technology. Had the steep drop here, barely a drop in the AD line, and we came right back up as soon as we got any buying. So these are probably the 2 most important sectors in my view And the fact that they're struggling is a negative, but the fact that the AD line continues to move higher, or at least threatening breakouts while price is moving down, that tells me that at least there's accumulation, that the AD line is based on where you finish in a particular trading period. This is a daily chart. So where you finish in the day relative to your high and your low. That percentage, if you're right in the middle, then there's going to be no change in your AD line. But if you finish all the way at the top, let's say you finish right at the high of the day, the AD line takes the volume and will multiply times 100% because you're all the way at the top, and we'll add that to the previous day's volume. That's why you don't see any numbers or anything out here to the side. It's just a cumulative, it's just a cumulative number that has gone over a long period of time. There is really no number to assign. It's just whether or not the AD line is going up or whether it's going down. And you can see it's at a 6-month high on the discretionary, and pretty much the same thing on technology. Now, if you finish at the bottom of that day's activity, then you're going to take that multiplier as minus 100%. So you're going to take the entire volume and subtract it. And then if you're somewhere in the middle, there's going to be a percentage involved of the volume. So if it's a light volume day to begin with, it's probably not going to have a whole lot of impact on the AD line. If it's a heavy volume day, it depends where you close versus where you were intraday. So that's how that works. Anyway, so I'm seeing mixed signals in the market, I guess is what I'm saying. I do like the market to sell off in the first quarter. I still think there are way too many warning signs for the market to just ignore and go higher. Not to say it can't do that. We've seen that before, but I think the risks of being on the long side are increasing. And that's really what I use technical analysis for, to evaluate risk, not to provide a guarantee. All right, moving on to the 10-year Treasury yield. First, we have the December PPI and core PPI coming out. So that's inflation at the producer level. And so that's going to probably influence the Treasury market, may influence the stock market later today. We'll have to just see. The expectation for the headline PPI number is for an increase of 0.4%. The core PPI is expected to rise 0.5%. Yesterday, we had the CPI, which rose 0.5, which was a little bit higher than expected. And the core CPI went up 0.6, which was also slightly higher than the expected. I think the expected was 0.5. So got another day of inflation reports, this one at the producer level. I tend to watch the consumer price index a little closer, but still, this is going to be a big report. And that comes out at 8:30 this morning. Initial jobless claims, 205,000 is the estimate. Last week was 207,000. That too will be out at 8:30 this morning. Of course, by the time you're listening to this, both of those reports will be out, so you'll want to check on that. All right, let's move on. I want to take a look at the S&P 500 on the top here. Then down at the bottom, what I've done is I've put in the core CPI. But the way I've set it up is I've gotten rid of the monthly data. So I've made this an invisible chart. And then I have an overlay, the rate of change, which is a 12-month rate of change. So it gives us the annual core inflation rate, which yesterday jumped from, I think last month it was 4.9. Now it's up to 5.5%. And it's going to continue to go up. The big thing that happened was that the December core CPI went up 0.6%, but the core CPI from December of 2020 was flat. So what we did, when you have a 12-month average or this 12-month rate of change, we got rid of the flat month from December of 2020 and replaced it with a 0.6% rise in December 2021. So that's why we saw that annual rate jump 0.6%. Now, the bad news in terms of inflation going forward is that January of 2021 and February of 2021 were both relatively flat periods. I think January was 0, and I think February might have been a rise of 0.1%. So as we get the CPI number out, the January number will come out in February. The February number will come out in March. So the next 2 months, February and March, we are going to see this core CPI number rise to a level that we had not seen since back in the early 80s when we were coming down from the stratosphere. So we're talking about 40-year highs that we are going to set over the next 2 months. I think that's one thing that's going to spook growth stocks. It could spook even the largest growth stocks, the Apples, the Microsofts. That's why I've been kind of issuing some warnings there to really pay attention to the technicals. You know, will it happen? We don't know. Could it happen? I think it could. So I would just make sure I have my stops in play. If you disagree and you want to make sure, you know, you're in those top stocks, Apple, Microsoft, Google, Tesla, I get it. They've been great performers and they haven't broken down yet. Well, Microsoft, I guess you could argue a little bit. But my point is, I would just make sure, given the fact that we know what's going to happen or what's very, very likely to happen with inflation in the next 2 months, growth stocks could take a hit. And we're talking about companies that really haven't taken a hit over the last couple of years since the March 2020 bottom. If they start to roll over, it could be bad news for the market. And look, I mean, the market, this is the S&P 500. If you connect these lows and then connect these highs, and we can do that. All right, so if I connect these lows, and this is on a weekly chart, but let's just connect right at the bottom. And then I take this and I drag this up to here and connect the highs. I want you to see kind of what's happening here. So if I connect all these highs, this high, this whole series of highs, this high, look at where we are right now. We're actually the upper band of this channel. You know, we've seen pullbacks from this level before. Here in 2010, here in 2011, a lot of choppiness, sideways action for a year or more, 2015 into 2016. Then, of course, the trade war, 2018, the pandemic, which is when we went down and set what I consider to be like a generational type low, 2191 market down. I will tell you, well, my prediction, you'll never see it again. So just beware and be bullish. I mean, overall, long term, be bullish. But short term, yeah, could we pull back from here? I think so. The other thing I want to point out is I had someone mention, I can't remember whether it was an email, whether it was a comment on one of my articles, maybe it was this Q&A, you know, a question that was sent in during my Trading Places live show or one of my webinars. Anyway, someone mentioned that back in the 1970s, why should we worry about inflation? Because in the 70s, the market went up with inflation. Well, that's partly true. When we first saw the huge spike in inflation, and I'm talking about the first one that took us up in the double digits, that was from early 1973 to 1975, that 2-year period right there. On that massive surge, we saw the S&P 500 lose 50% in 2 years. So to just say, well, inflation doesn't have an impact on the S&P, I think that's an incorrect statement. Now, the next time we went surging to the upside, even higher than that 12%, we got all the way up to about 14, 15%. It's true. I mean, we were right here, I guess, when we peaked. And when we started, we were here. So we went up a little bit. We didn't go up a lot, but we did actually go up. And it may have been the market simply anticipating, you know, the market does look ahead, not usually 2 years ahead, but normally it does look ahead. And maybe the market was just anticipating that we were going to reverse. I don't know. It's been over 40 years. I wasn't investing back then. But I think just to make a blanket statement that inflation doesn't have an impact on stocks, it does. It has a major impact on valuations. There may have been other things taking place back in the late 70s, early 80s. I don't recall all the issues of the time, but inflation definitely is an issue that we need to be aware of. Now, these green dotted vertical lines here that you see, this is when inflation peaks. So here's a peak, 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 small peak here. Actually, could have drawn one there. There was another small peak there. Of course, that was during the dot-com bubble, so many of the technology names kept going lower anyway. And then, I don't know, not really a peak there. It was very, very low. But anyhow, my point on this is that when we peak, you can see that after these peaks, the S&P 500 normally goes higher. I mean, that's been the history. So I believe when we peak, which is likely to be in March, could be April, I think once we peak, I think that is going to be the start Maybe not right at that moment. Maybe we still struggle a little bit in the early summer, but I believe the second half of 2022 could be a lot better than the first half if I'm right about this pullback in the first quarter. And that, we'll have to wait and see. Anyway, I just thought this was an interesting chart, wanted to share with everybody and also show you how you can, set that up. So again, down at the bottom, these PPI and CPI charts, they're monthly. They come out monthly. So I always set the period to monthly. Otherwise, you do daily, it's going to have one spike and then it's going to go flat for a month. And then it's going to be another spike and then flat for a month. And then the daily chart makes no sense. So if you're going to look at a month, something that comes out monthly, you want a monthly chart. That's the first thing. Then down here under indicators using price, dollar CCPI, core CPI. That's what will get you the readings, and then make the style invisible. Under the, this will come up auto, but just change it to invisible and then put an overlay. So we don't see all the month's data. See, if I wanted all the month's data, what I would do is I could put candlesticks in here. And then you would see all of the data right here at the bottom. And if you look closely, you'll see these flat lines going for a month because I did a candlestick chart and they don't change for 30 days. But anyway, there's the data. And now there's the overlay. It just makes things a little bit more cluttered. So if you just change that to invisible, then we get rid of all the data and we're just looking at that 12-month rate of change. All right, moving on. How about let's, with momentum sleepers, what I want to do is I'm going to run a scan. And I was trying to think, okay, let me go back to the S&P 500 for a second. Let's pull this up. So I was looking back, I was just thinking, okay, a couple of weeks ago, we had a pretty strong rally. And I know we had leadership from areas other than value. I mean, back then, we still had software stocks that were strong. We had, semiconductors doing very well. And some of those areas have struggled over the last 2 months. So when I wrote the scan, I thought, okay, I want to go back a couple of months and pull up. In this case, I did 8 weeks ago. The weekly PPO line was greater than 10. That's pretty good strength. In order for the PPO to go higher than 10, your 12-week EMA has to be more than 10% above your 26-week EMA. So that's just showing you that your short term is way ahead of your long term. So you've got some pretty strong momentum when your weekly PPO is greater than 10. Now that was 8 weeks ago. Now I'm saying, okay, what's it? Give me the scooters that are less than 50. So anything that was really strong 2 months ago, 8 weeks ago, and now has a scooter ranking, scooter score below 50. That's what I want. And I'm looking at the New York Stock Exchange and the NASDAQ. I'm looking at a weekly simple moving average volume of 1 million shares. So that's 200,000 a day, roughly. So I just want to make sure there's some volume there. And then I just set it type to stock. And then New York Stock Exchange, NASDAQ gets rid of a lot of the foreign stuff, gets rid of the ETFs and so forth. So I run this scan and let's see what we come up with. All right, so the scan comes up with 34 stocks. I'm going to go ahead and replace into an existing chart list. Go down to one of my scan folders, scan results. Well, it doesn't matter which one I put it in. I'll just stick it in this one. All right, and now what I can do is I can put these into Candle Glance, very similar to how I set up my opening, when I do the daily market recap. And now I can just quickly look to see what's going on. Well, definitely got me what I wanted, because you can see from the last 2 months, all these stocks have pulled back quite a bit. Now, the question is, and maybe another thing I should have added, and maybe I'll add that now, is I don't want the scooter down really low. I don't want something that's just been going straight down. So maybe what I do is I add one more, and I don't know what this is going to do, but if I do the scooter, and let's make sure it's greater than 40. So it's less than 50, but it's greater than 40. And then I run that scan. All right, now there's only 6, but these shouldn't be as beaten down. So let's replace, that's going to be a lot easier to look at 6 charts too. Let's go ahead and put them, save them into that same folder. So we're overwriting that folder. Anytime you save a scan and you say replace an existing chart list, all those prior charts are gone. You can merge it into a list, which means it just adds to what's already there, or you can set up a new chart list. but I'm going to rewrite it because I didn't need that old scan at this point. Now I can just, because there's only 6 of them, I'm just going to do 10 per page. I can go through these pretty quick. So AMTX, I'm looking, is there any kind of a key support level? Is there a positive divergence? Is there anything to get me excited about this momentum sleeper? Clearly, it had momentum 2 months ago. Now it's gone to bed. I mean, the momentum is gone. So it keeps trending below the 20. I'm not excited yet. Divergence, it's starting to maybe try to turn back to the upside, but it just hasn't given me any other signs just yet. And we could look at the AD line. AD line's held up fairly well. Big Five sporting goods, huge move back in first half of November. Since then, though, we've fallen all the way back. Interesting part here is we held the gap support from over here. We went literally right down to that gap support at 17.5. Haven't been able to get back through the 20 days. So maybe if we could get a close over about 20.5, that might start to, jumpstart the momentum, and maybe we get the bulls coming back in. AD line here, though, has not been good. The PPO's turned up, but we haven't put in a lower price, so there's no positive divergence. Next up, Codexis, CDXS. Another one's been downtrending. PPO looks very weak to me. I think we could easily go down to this gap support, so maybe look for about 23.25 to the downside here. Still got a couple dollars, it looks like to me, so I'm not interested there yet. CERE, I'm seeing a head and shoulders breakdown. Right here, left side of the neckline, right side of the neckline. So you're going up. This is your left shoulder, neckline, head, neckline, maybe even a retest that neckline, right shoulder, pick one. And then it looks like we've broken down. Now, I'm not seeing a massive amount of volume, but that's because this one volume day really skews the chart. So we could maybe pull it up and look at a 3 or maybe a 5-month chart and get rid of that volume and see what the volume looks like there. But regardless, it did break down. I would be really careful. I think any trip back to the 20-day would be an opportunity to short. And right now, I'd say that the path of least resistance is to the downside. Montrose Environmental Group, MEG, breakdown here. This is actually one that looks kind of interesting to me because actually, we'll come back to that one. You don't have one more. Let me look at this OPRX. Here's a support level down around 40. We did go slightly lower with a positive divergence on this one. So maybe we make one more move up to 63. I don't know. I'm not really, I don't see a whole lot going on here. What's the AD line? Well, AD line's going up while price action's coming down. So this is one certainly to consider. But if it went down one more time, I think 50 is where I'd feel a little bit better from a risk standpoint. If you get in here, I'd probably want to at least hold through 50. So you're going to give up 6% just to get down to 50. I would just, in this market, I don't feel compelled to make any trade too soon. So just see if it gets down to 50, right? But anyway, let's go back up here to this one. And I'll show you why I think this one is interesting. So, if I'm looking at it, I think it's gone back down and tested a key area of support. So that was the high. You can see all these tops coming in here. You can see the volume starting to pick up here as we go through and we set a new high. And I think really we've come back for the first time to test this area of support. So the other thing that I would do is on a stock like this that's been going down, I would look at an hourly chart and see if there's a positive divergence starting to set up on an hourly chart. Well, these two lows looks like maybe it kept going a little lower, but you can see the volume's been coming in. The AD line actually has been surging on the hourly chart. This one of the 6 is the one that kind of gets my interest more than any of the others. But you want to make sure if it fails that you have your stop in place. So if you did trade this one, maybe that low at 57 would be the area to keep a stop. But I think to the upside, you could go back to the 20-day easily. That's where we broke down from about 64. I could see a $5 move to the upside. So $5 upside versus $2 downside. And if you wait and maybe get 50 cents off, if it goes down a little bit today or something, you can even improve those, that risk reward even more. So something to think about there. So anyway, that's your momentum sleepers. That's just a one way to maybe look at some stocks that have been, that's kind of fallen by the wayside that were prior leaders. This was a stock that went from 45 to 80 in 3 months? Now you can get it at 59. So definitely a momentum sleeper there. All right, moving on. Earnings spotlight. Just wanted to, the only company coming out today of any significance with earnings is Delta Airlines. And so you can see Delta, the AD line, not great. Price action mostly trending lower. Are they going to have anything good to say about the Omicron variant, and how that will impact future travel? I don't know. We'll see what happens. I think it's probably still a little early. It looks like Delta is beginning to trend higher. I like that golden cross where the 20s come back up above the 50. I think there's some things to like here. But airlines have started to strengthen a little bit, but that AD line worries me. And just this group's been a nightmare really for the last couple of years. So maybe need to see something there first. The other thing I'll mention too is JP Morgan kicks off earnings season. It's among the headliners for tomorrow. I mean, obviously Delta is reporting today, but earnings season really gets its kickoff from the big banks. I always look at that as the day where earnings season really begins. And so JP Morgan reporting tomorrow before the bell. A number of big banks, Wells Fargo. When I'm looking at JP Morgan, I see the AD line, which has been going down. It looks like a lot of distribution. Look at JP Morgan relative to the bank index. What the heck is going on? This has been one of the best banks. I don't like the way it's trading. So look at another bank, though, like Wells Fargo that'll report tomorrow. Here we got the AD line, which is much better than JP Morgan's, although, honestly, it's not great, but it has started to pick back up again. We've gotten a new breakout, and look at the relative strength of Wells Fargo. It actually is setting a new 52-week high. This has been one of my favorite banks for a while, and I think they're going to have a good report. Now, it may pull back after the report, buy on rumor, maybe sell on news, but I think if it has a good report and pulls back to the 20-day, I'd be a buyer. All right, couple of other banks that will be reporting: Citigroup, and then also I think FRC is a pretty strong one on a relative basis as well. First Republic Bank. Oh, actually, it was 2 months ago. It's actually come back down quite a bit, especially here in January. A lot of volume, but the relative strength's gone down. AD line coming off 52-week low. I don't know. This one doesn't look as good as it did, say, a month ago, for sure. All right, moving on. 3 you must see. All right, 3 Dow stocks. Going to go through these pretty quickly. First up, Nike. Nike short term, I kind of like this setup here. We gapped down, and then yesterday we gapped back up again, kind of leaving those 2 candles on an island. So we'll see if we can continue to rally. I think the big support level is going to be 145. If it does go lower, so I think if I were to get in here with a little bit more of a mid to longer term time frame, I think I'd give it down to about 144 support. We had prior highs at 145, by the way, before we gapped up. So we went back down there. I think that's the key support on Nike. Next up, Microsoft. I mentioned earlier that it came back up, but struggled, didn't really have a great, went up 1%. That was good. But as I mentioned to members a couple of days ago, I was looking at this chart. You had the double bottom at 320. I kind of felt like 320 was going to be the first area of resistance. And then you had the 20-day. We went up and we failed just beneath the 20-day and couldn't close above 320. So got a little bit of a problem there. That's what I would be watching. If we fail and go back to new lows, that could be the start of a downtrend that I'm looking for to develop in the first quarter of this year. Honeywell looking much better to me though. So Honeywell, you can see over the last 3-4 weeks, really strong move. The recent pullbacks have held the moving averages, and we bounced back up to new highs. So I actually think Honeywell is starting to turn its chart around as long as it continues to trade over the 20-day. And this could be some of the rotation that we're seeing in the first quarter away from some of the, highly aggressive growth stocks and more into some of these value plays. So Honeywell, I think, looks pretty good right now. All right, that's it for me. Want to thank everybody for tuning in. I'll be back on Monday with your next Trading Places Live. Of course, you'll have to get that over at earningsbeats.com. Listen, everybody have a great weekend. Be safe out there, and hopefully the market will stay strong, but be prepared in case it doesn't. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.